Nick, welcome. It's great to have you with us. Consumers, I mean, investors are certainly chastened and a little bit concerned about the economic future. How about people who are going out to eat out, restaurant patrons?
Well, thanks for having me, Tyler.
You're welcome.
So, look, we saw transaction trends trough in the first part of July. Since the first half of July, we've seen transactions accelerate. And so, it seems like as of now, people are going out, and they're going out because gas prices are down, because employment is still very healthy. And the lowest income consumer is actually getting the kinds of wage increases that are exceeding expectation.
So the business is healthy. Your picks, or the ones you like best out of your coverage universe, include Wendy's, Denny's, Dine Brands, and Wingstop. Why those?
Well, there are different reasons for each. Essentially, I think those are, relative to their growth rates, the most undervalued right now. Wendy's, there's a big dislocation going on because of the E. coli worries that the news came out a couple of weeks ago. I think they were very quick to address it. I think it will be contained, and there's probably about a 15-20% dislocation within the share price within the last couple of weeks just because of the E. coli news. Wingstop is the best growth story within restaurants. The 30 EV/EBITDA multiple seems very high, in the current environment. But just for context, McDonald's, commands a 18 EV/EBITDA multiple. Domino's commands a 20 EV/EBITDA multiple, and Wingstop is 2 to 3 times the growth rates of those names. So, especially within the smaller cap and mid cap space, there are big dislocations within restaurants right now.
Nick, I'm curious. We've heard that some of the supply chain issues have begun easing. For restaurants in particular, what are the big headwinds going into fall?
Well, we certainly have seen supply chain headwinds ease. We've seen essentially margins trough either in Q2 or Q3. They will trough here in Q3. The biggest headwind that is just the direction of the declines in terms of food costs, and then where labor inflation stabilizes. So, the argument is sort of mid to high single digits in terms of labor inflation exiting Q4, and hopefully we start to see by the first half of next year mid single digits in terms of labor inflation, and by Q2 of next year, hopefully we start to see those commodity costs, which have been up high teens, 20% year over year this year. Hopefully we start to see those flatten out.
And generally speaking, have restaurants been able to find the employees that they need? Is the labor crunch easing somewhat?
The labor crunch is easing, but it's still very much there. And so, if any, we have been hearing a lot, about layoffs, et cetera, but it tends to be within the tech, biotech sectors, lending, real estate, et cetera. But those are, median incomes or higher, right? So within the unskilled labor population, there's still a very, very big need for labor as the services, the service industries come back from COVID.
All right, Nick, thank you very much. We appreciate your time today.